Here's what people get wrong about whole life insurance. They compare it to the stock market. It's basically like comparing the foundation of a house to the roof of a house. The bottom line is they do completely different jobs. So in this video, what I'm gonna do is show you exactly how the cash value grows in your policy, why dividends matter probably way more than you think they do, and why the rate of return question that everybody asks about why whole life insurance doesn't make as high of a rate of return, or what is the rate of return, why that's the entirely wrong question to be asking. I'm gonna be talking about guarantees, dividends, compounding, and how this tool of whole life insurance becomes exponentially more powerful as you go over time. So, hey, I'm Chris Kirkpatrick. I'm the founder of Life 180, and this is video 2 of our series on the top 34 questions about whole life insurance. If you haven't watched video 1 yet, go back. It's on the general understanding, so make sure you go back and watch it first because it's gonna give you the foundation for what we're covering today. So let's dive in. All right, so question 1, how does your cash value grow over time? Well, your cash value grows through 3 distinct mechanisms, and this is where whole life insurance becomes exponentially more powerful than most people realize. See, most people think that it's just one thing. You pay a premium, some goes to the insurance, and some goes to the cash value. Now, that's partially true, right? But the bottom line is it's way more sophisticated than that. There are actually 3 growth engines that are working simultaneously inside of a properly structured whole life insurance policy. And when you understand how they work together, you'll actually see why this becomes such a powerful wealth building tool. So the first is that you have guaranteed growth, right? Every premium that you pay adds to your cash value. Now, of course, you minus out the cost of insurance and the fees in the early years, but here's the key. The insurance company guarantees a minimum growth rate on your cash value, not your account value, your cash value. That's the difference between whole life insurance and IUL, right? Now, most policies today with current interest rate assumptions are averaging about 4.5% from a long-term guaranteed growth rate. While I can't say that this is guaranteed, it's as close to guaranteed as anything in the financial industry. These companies have never missed dividend payments for the past 100+ years. For some companies, it's been 180 years, right? So it's a big deal in any economic environment that we're in. Think about that for a second. In 2008, when the stock market crashed by 37%, whole life insurance policies kept growing. In 2020, when COVID hit the market and it dropped by 34% in a single month, whole life insurance policies kept growing on a guaranteed basis. And in 2022, here's a crazy part, both the stock market and bond market lost money in the same year. Now, that was something that wasn't supposed to happen according to traditional portfolio theory. Here's the bottom line, whole life insurance still kept going up in value. That guaranteed growth is the foundation of everything that we talk about. It's the bedrock of your personal finances, and it's contractually guaranteed to grow every single year. We're going to get more into this in question 3. Now, before we get there though, let's get into growth engine number 2, dividends. When you own a whole life insurance policy with a participating mutual company, you're not just a customer, you're partnering with the company. You become a participant in the profitability of that company through dividends. It's basically the equivalent of being a shareholder with a publicly traded company, except for the fact that you're a policyholder in a mutual company. Now, dividends are technically not guaranteed, so I need everybody to understand this, but here's what's important. The top mutual companies, I mentioned this a couple minutes ago, have paid dividends for over 100 consecutive years. That's why I always say it's more guaranteed than any other financial tool on the face of the earth. Through the world wars, through the Great Depression, through the 2008 financial crisis, through the pandemic, these companies have paid dividends every single year. It's powerful. So while they're not legally, guaranteed, and I guess I would call them the non-guaranteed component of the policy because they're based on the company performance, the track record speaks for itself. These dividends are going to compound for you on top of your guaranteed growth. So you've got, your 2% to 3.75% guarantee from a 7702 update. But on top of that, you're going to have more dividends that add above and beyond that. And those dividends are going to fluctuate. I'm going to talk about that as we go through this video more. And while I'm going to break down the dividends in greater detail in the next question, just understand this for this component for growth engine number 2. Dividends are what take a good policy and they make it great. They are basically fuel on the fire. They're the accelerant that helps it grow faster. So growth engine number 3, the third growth engine is what I call compounding on compounding. And this is where whole life insurance becomes exponentially more powerful over time. Here's how it works. As your cash value grows, your dividend base grows as well. In year one, you might have $10,000 of cash value and get a $300 dividend, right? But in year 20, you might have $200,000 of cash value and get a dividend of $8,000 for the same policy. It's the same dividend rate, but the base is bigger, so the dollar amounts start growing as well. They all scale together, but it goes way deeper than that. If you're using your dividends to buy paid up additions, that's what we call PUAs, which we'll talk about in the next question as well. You're buying more insurance, which increases your cash value at the same time, it is also going to increase your dividend base, which buys more insurance, which increases your cash value, right? You see the cycle of this thing? You see where this is going? The compounding accelerates over time. It's the opposite of what happens when you're dollar cost averaging into the market with volatility. You're building compounding on certainty, not volatility. Every single year, the base gets bigger. Every year, the growth gets larger in dollar terms. Volume over rate of return. That's what Nelson Nash always taught in the infinite banking concept. This is why policies that are 30, 40, 50 years old become absolute wealth building machines. The first 10 years of the policies, you're laying the foundation. It's a little slower than some people would like, but methodically, it works. Years 10 to 20, you're building on that foundation and it's going faster. You're going to start building momentum. Years 20 and beyond, now you've got the momentum, and it's the structure, it's the building itself that is going to help you build that compound growth. Now, I've seen policies that were started in the 70s with $5,000 of annual premium that now have over $2 million of cash. That's the power of all three growth engines working together over a period of decades. So those are the three growth engines. Guaranteed growth at around 4.5%. We can kind of say dividends that have been paid for over 100 years or more on a compounding basis that accelerates over time. Now, I want to talk about dividends specifically because this is where most people's eyes are going to glaze over, but it's also where the real power of whole life insurance actually lives. Now, most people think that dividends in whole life insurance are like stock dividends, nice bonuses that show up once a year and you can do whatever you want with them. And while you do have some options, dividends in whole life insurance are fundamentally different and far more powerful than most people realize. So let me explain what they actually are, where they come from, and then we'll talk about the 4 ways that you can utilize dividends and which one of those ways that I think is a secret sauce that you should use to build your wealth and ultimately create the life that you're trying to create. So here's what dividends actually are. When you own a whole life insurance policy with a mutual company, like I said, you're a part owner of that company. Mutual companies don't have stockholders. They're owned by the policyholders. So when that company does well, you as the policyholder participate in the success with that company, right? It's a key distinction to understand. So here's how it works. The company takes a premium from all the policyholders. They take in all those premiums from all the policyholders. They invest that money conservatively through the general fund, mostly in bonds, real estate, mortgage-backed securities, really safe, predictable assets. And then when they perform better than expected, they share those profits with the policyholders. That's your dividend, right? The other way that they can increase their profitability is based on something they call mortality experience. It's basically the mortality costs that they experience with the life insurance company, because it is life insurance, right? So if fewer people die than expected, the company is going to have excess funds. If expenses are lower than projected, then there's excess funds. All of those funds get returned to the policyholders in the form of dividends. So it's key to understand that this isn't a bonus. It's your share of the company's profitability. You're partnering with them. They're sharing the upside with you because you're a participant, not just a customer like you would be in an IUL policy. And again, while technically non-guaranteed, the companies that we work with like Lafayette, MassMutual, Guardian, Emeritus, and One America, these all have exceptional track records when it comes to consistent dividend payments. A lot of these companies are spanning, well, every single one of them spans over 100 years, and companies like MassMutual and Guardian, you're looking at 160 to 180 years and up. I don't know about you, but from my perspective, that's a pretty solid track record that we could depend on, even if it is non-guaranteed. So now let's talk about the 4 ways that you utilize dividends. When you receive a dividend, you're going to have 4 options that you can choose to utilize them for. How you utilize them and the option that you choose is going to dramatically impact the long-term performance of your policy. So let's get into it. Option 1. Take your dividend as cash. You can take the dividend as cash flow. It shows up, you get a check or a direct deposit in your account, whatever you want to do with it, right? Like As the dividend gets paid, you can just kind of take that dividend as cash. Now, I want to be honest with you here, and I want to tell you about this because it is an option. And I want you to know that it exists just so you're aware of all your choices, but it's also not what I typically recommend during the growth phase of a policy. Because when you take the dividend as cash, you're taking a lot of the power off the table for the growth of the policy. That said, once your policy is mature, if you hit retirement, using your dividends as a supplemental cash flow can be a strategy for the right person in the right situation. But I just want to make sure you understand that during the accumulation phase of the policy and in your life, there are much better ways to utilize the dividend. So dividend two, option number two, is that you can reduce premiums. The second option is that you can utilize your dividends to offset premium payments. So if your annual premium is $10,000 and you get a $2,000 dividend, you can actually apply that dividend to reduce your out-of-pocket cost to $8,000. This is what I call premium offset. I absolutely love this feature for the right people. A lot of people don't realize how flexible life insurance can be, whole life specifically, utilizing the premium offset feature in down markets, in times where you maybe lose your job, or anytime you even need to reduce or eliminate your payment for that year for any given reason. It provides the flexibility to do so. In fact, it's important to understand that with a well-designed policy, you can often reach the point where your dividends are going to fully cover your premiums. And if you're able to come with a fairly good-sized front load on the early side of the policy, you should be able to have your dividends cover your premiums by year 7 or 8 in the policy. No other financial asset in the world is going to do this for you. All right. So now let's go to option 3, which is paid up additions. This is the secret sauce, right? This is the one that most people know about, everybody talks about. This is what I use in what our Rockefeller method strategy is and how it supercharges the policy. When you use your dividends to buy paid up additions, you're using that dividend to purchase more whole life insurance. And here's what's beautiful about it. It increases your death benefit at the same time. It increases your cash value immediately, and it doesn't require any additional underwriting every single year. No health questions, no medical exams, no jumping through hoops every year. The bottom line is that those paid up additions immediately start earning dividends themselves, right? So you're going to have growth on growth on growth. That's the compounding on compounding that I was talking about before. So now you've got more insurance, you've got more cash value, and next year your dividend is bigger because your base is bigger. And that bigger dividend is going to help you buy more paid up additions, which increases your death benefit, which increases your cash value again, which earns bigger dividends. This is compounding on steroids. This is what I talk about all the time, right? This is how policies that start with a $500,000 death benefit can end up with a $2 million death benefit 40 years later. This is protection against inflation, right? You're building both your cash value and your death benefit simultaneously. Now, you're not having to qualify for this coverage year after year as well. So I just want to reiterate that. Now, this is my favorite way to structure policies, hands down. This is what we do to implement the Rockefeller method. And bottom line is, if you want maximum growth, maximum flexibility, and maximum long-term power, then you buy PUAs with your dividends. It's just what you do. So now let's go to option 4, which is accumulate with interest, right? The fourth option is to leave your dividends with the insurance company to accumulate at interest. They sit in a side account earning interest and you can access them later. Now, this is fine, but honestly, buying PUAs is almost always a better choice. It's good to know that you have this option, but it's not an option, honestly, that I've ever had any of my clients take advantage of. It's going to give you more cash value and it's going to give you a bigger dividend base for the long term, but it still doesn't compare to what the paid up additions will do for you. So those are your 4 options. And if you caught the theme, hopefully I made it pretty abundantly clear, buying the paid up additions is where the magic actually really happens. That's why everybody focuses so much on this. Paid up additions are basically how you turn a good policy into a wealth building machine. And that is the Rockefeller method in action. So are your cash values guaranteed to grow every single year? Well, the quick answer to be direct is yes. The guaranteed cash value increases in your whole life insurance policy every single year. This is contractually guaranteed, legally binding. The insurance company cannot reduce it, period. Once again, this is unique to whole life insurance. I want to say that again because this is one of the most powerful features of whole life insurance. Now, your cash value can only go up. There is no year where you check your statement and your cash value is going to be less than it was the year before. There is zero volatility, zero standard deviation, zero market risk, only upside, right? Now, here's the nuance that you need to understand with it. When you look at your policy illustration, you're going to see two sets of numbers. You're going to see a guaranteed cash value, which assumes zero dividends. It's only focusing on the guarantees. It's the contractual minimum that the company is going to provide you. With regulation section 7702, you're looking at, with depending on the company, it's going to be between 2 and 3.75% on the guaranteed. Then on the other side, we have non-guaranteed, or what they call projected cash values. This is going to assume that dividends continue at the current rates, right? You're going to get a dividend every single year at this year's rate. Now, the guaranteed number is obviously lower than the current assumption, and it's a conservative. It's a worst case scenario. I always say, I make my decisions through what's the upside, what's the downside, can I live with the downside? Well, the guaranteed rate is the downside potential there, right? So here's the thing, is that in reality, over the next 30, 40, or 50 years, the actual cash value will end up somewhere probably in between these two numbers. But in today's environment, we're at historically low rates. So I could actually make an argument that your policy could potentially outperform. Now, I'm not saying it's going to happen that way, but it's really important for you to understand just how these policies work. And here's why this matters. Whole life is the only financial asset that I know of that only goes up every single year by contract. The bottom line is stocks have down years, sometimes catastrophically, right? Bonds have had down years, right? 2022 proved that bonds aren't as safe as we thought. And real estate can have down years. 2008 showed us this, right? Like, the market is cyclical. It's not linear. It doesn't just go up in this straight curve. The only asset that does that is whole life. Crypto, don't even get me started there. I like crypto, but it's wildly volatile. Whole life, every single year goes up, hands down. That's not me giving you some marketing hype. It's not a sales pitch. That is contractual law. It's in writing. It's guaranteed by some of the oldest, most stably financial institutions in the entire world. This is why I say that whole life insurance should be the foundation of every single financial plan. You have to build the certainty first, and then you can take calculated risks on top of that foundation. You don't build your entire financial future on a volatility. If you've been watching my videos for a while, you understand that I just believe that you're not supposed to build your entire financial future on volatility and hope. Hope isn't a strategy. You start with guarantees, and whole life insurance is going to give you the guarantees that will help you build your foundation to build everything on top of. So can you lose money in a whole life insurance policy? Well, in the cash value itself, the answer is no. You cannot lose cash value once it's in the policy. It's locked in and it can only go up. But I want to be clear, in the overall transaction of whole life insurance, meaning that comparing premiums paid to cash value available, you can have situations where you're not breaking even, right? It's important, especially early in the policy. In the early years, that's what scares people. So let me explain exactly what's happening and why this isn't actually a risk if you understand how the tool actually works. Once the cash value is in your policy, it cannot decrease. It cannot go down in value. There is no market risk. There is no volatility, no possibility of loss of the cash value account itself. However, in the first several years, like I'm going to just say year 1 through 7, right? You might have less cash value available than the total premiums that you've paid in. Why? Well, it seems pretty obvious, because you're paying for insurance coverage, which has a cost, right? You're building equity in a long-term asset. And this is what causes people to freak out. They pay $20,000 in premiums in year 2, and they check their cash value and they see $12,000 and they think, oh my gosh, I'm losing money. This is horrible. Well, first of all, if you're doing that, you're probably designing the policy improperly. But even if you are, bottom line is you're not losing money. You're building an asset that matures over time. It's like buying a house. You pay a down payment, you pay closing costs, and then 2 years later, if you sell it, you might not get all your money back because you haven't built enough equity in to cover all the fees to get the place. Does that mean you lost money? No, it means you quit before the asset matured, right? Same with a 401k. You put money in a 401k, you don't have access to that money until you're 49 and a half or 59 and a half without paying a penalty. Does that mean you lost some money? You look at that and you're comfortable with it. It's the same deal. Good news is that whole life insurance matures way faster. More good news is the way that you design the policies is also really important. We always want to make sure that we're maximizing the cash value as much as possible from day one, utilizing those paid up addition riders. Now, when you do this right, most of our policies are break even, meaning they have as much cash value as you paid in total premium by year 4 or 5, right? That's pretty powerful. So even if you needed to surrender the policy or cancel the policy for any reason, you're not going to lose money as long as you can make it to year 4 or 5. You're breaking even or you're slightly ahead from that point forward. And at that point in time, you're building pure equity in the policy. But here's what most people don't know. You have incredible flexibility built into these policies to mitigate any risk of loss as well, right? So you have a feature called reduce paid up, we call RPU. After year 7, you can invoke what we call the reduce paid up feature at any point in time. This means you can have the ability to stop paying premiums. The policy stays in force and the death benefit and cash value adjust downward to what your paid up premiums will support, right? The policy continues to grow and you never have to pay another dime. There's no more fees. It's completely paid up for life. This is completely unique to whole life insurance. A lot of people show in IULs, Index Universal Life, they show vanishing premiums telling you that you never have to pay at that point in time moving forward. People like Doug Andrew and other influencers will say that you can 5-pay IULs and it'll be paid up. This is one of the number one reasons that IUL companies are getting sued because of that misrepresentation. You can never pay up an Index Universal Life Insurance policy like you can pay up a whole life insurance policy. So the bottom line is that if life throws you a curveball with whole life insurance after year 7, let's say you lose your job, your business struggles, or whatever happens in the world, you're not going to lose your policy. You could just convert it to a reduced paid up status, maybe do something else. Maybe you get into let's talk about the next option here, which is the premium offset feature. This is a feature I mentioned earlier, and I love leveraging the premium offset feature because the bottom line with the RPU feature is once you do it, you can't go back. That's important to understand. Right? With the premium offset feature, once your dividends are large enough, you can use them to offset your premium payments like we were talking about, right? So even if you don't want to invoke the RPU feature, you can stop paying out of pocket and let the policy's own dividends cover the premiums. It becomes self-sustaining and it doesn't cannibalize itself like an IUL would. These features create way more flexibility than most people even realize is possible with whole life insurance. The main risk, if you want to call it that, is really in the first 4 to 7 years of the policy. And if you design it correctly, we can even mitigate that risk pretty significantly. So can you lose money? That was the question. Well, only if you quit in the first few years because that's before the policy is going to be more mature, right? But if you understand that this is a 10+ year commitment and you design it properly from the beginning, then you're not going to lose anything. And you're going to have backups to protect yourself in the process. You're building a self-completing asset that grows tax-free, you can access tax-free, and pays out tax-free to your family should something tragic happen. So question 5, what rate of return am I going to earn on my policy? Now, this is the question that every single person asks, and I'm going to tell you right now, it's the wrong question. However, I promised I'm going to answer all these questions, so I'm going to answer this, and I'm going to show you why it completely misses the point and why asking the right questions actually changes everything. So here are the numbers. Over the life of a policy, let's call it 30, 40, or 50 years, most well-structured policies are going to show returns that mirror the bond market. That's just the way it works. You can expect long-term performance that are going to be very similar to bonds. Typically, this is going to be in the 4 to 6% range when you factor in dividends and paid up additions, and we do the right blends and the right design of the policies. Now, bottom line is the earlier years are going to be lower because of the cost and the insurance and the expenses and the fees and everything that goes into it. But the later years are going to be higher because of the compounding. Now, by year 40, your policy might be growing 6 to 8% annually in real dollar terms, depending on what the dividend rate market is and the interest rate environment at that point in time is, right? So if you're thinking that that's lower than the stock market's 10% historical average, well, guess what? You're right. You're also thinking about it improperly. So here's the reframe. Whole life insurance returns are going to mirror the bond market, like I just said. Here's the difference. While bonds can lose money, whole life insurance can't. So what you're doing is you're shifting the year-to-year risk to the insurance company. The insurance company is going to take the risk and you get the stability and you get the returns that mirror the bond market. And in exchange for that, you're shifting the risk to the insurance company. They take the risk, you get the stability. However, in exchange for that guarantee, you get returns that are similar to bonds. It's important, right? So you're not going to have the same upside as a market, but you're going to have zero downside risk. So once again, we have to figure out what problems am I trying to solve here? Now, question is, why does this matter? Because we've been told for decades that the 60-40 portfolio, 60% stocks, 40% bonds, is the safe retirement strategy, right? Diversified, balanced, and conservative. That's what they're going for. The bottom line is the 60-40 portfolio has been proven recently to be more risky than originally thought. Why? Well, because in 2022, both the S&P 500 and bonds lost money in the same year, back-to-back losing years. That wasn't supposed to happen. It had never happened before. Bonds were always supposed to be the safe ballast when the stocks went down. That's the entire foundation of that strategy. Whole life insurance is simply a better bond. You get the same long-term results as bonds, but you get liquidity, leverage, life insurance, living benefits. You get tax-free growth, tax-free access through policy loans. You get a death benefit that pays out tax-free. Bonds don't give you that. When you look at it that way, it becomes a no-brainer to have. When you look at it that way, it becomes a no-brainer to have whole life insurance as part of your financial strategy. So the real question isn't what's the return? The real question is, what can I do with this money that I can't do anywhere else? Can you borrow against your 401k to buy rental property without triggering taxes or penalties? Probably not. Can you access your Roth IRA contributions and earnings before 59 and a half without penalties and without limitations? Not very easily. Can you create tax-free income streams in retirement that doesn't count towards your provisional income for Social Security taxation? Not with most accounts. Whole life is going to let you do all of this. It's going to grow with you as you grow. The return in the policy isn't the point. It's there, it's a utility, but the guarantees, the liquidity, and the tax treatment, that's the point. Now, I'd rather have a guaranteed 4 to 5% return that I can leverage, access tax-free, and use to create cash flow than a volatile 10% that I can't touch without taxes, penalty, and market risk. Structure beats strategy every single time. And whole life insurance is the ultimate foundation for the proper financial structure. So let's recap what we've covered today. Cash value grows through 3 engines. First, guaranteed growth that grows at about 4.5% after dividends are paid. And I know that's not guaranteed, but once again, when we look at the 100-year history, it's as guaranteed as anything in the financial industry. You're going to have dividends that have been paid for 100 plus years, and then you have compounding on compounding that's going to accelerate that growth over time. Now, dividends are your share of the mutual company's profitability. You're a partner, not just a customer of the company. And the best way to utilize those dividends is the paid up additions, which is the Rockefeller method, which supercharges both your cash value and the death benefit. Your guaranteed cash value increases every single year, contractually guaranteed, no exceptions. It can only go up. So remember, you can't lose cash value, and with proper policy design, you're break even by year 4 or 5, right? Plus, you have the flexibility features like reduced paid up and premium offset that are going to protect you in times of trouble, right? The rate of return question is the wrong question. Whole life gives you bond-like returns with zero downside, plus liquidity, leverage, tax-free growth, tax-free access, right? It's just a better bond. That's the way to look at this. Now, in the next video, I'm going to dive into utilizing the policy for cash flow, how to borrow against your policy, what happens to the death benefit in the policy, and why this is where the magic really can start to happen when it comes to building wealth and utilizing life insurance to do so. So if you're getting value from this series, all I can ask is hit the like button, subscribe, hit the bell, that way you're notified every time I launch a new video, that way you're notified when the next video in this series comes out. Drop a comment below. Let me know what your biggest aha moment, biggest education, biggest question that you have from this. I read every single question. It actually informs a lot of the content that I make. Let's elevate some consciousness around money with this. My name is Chris Kirkpatrick. Can't wait to see you on the next video.